investment world, historically, when I look back, various risks we consider while making investment decision, and we always used to highlight geopolitical risk. This is one of the risks one should always be watchful of. Over a period of time, given the fact that the global economy was becoming more of resilient in terms of the individual countries doing well, the geopolitical risk, despite seeing war between Russia and Ukraine, did not have much impact in the global economy. But however, this time the geopolitical risk has become really bad in the sense that it has led to significant rise in commodity prices, especially oil, coming back to the level at which it used to trade about, say, 10 years back. And second is related other commodities and the destruction in some of these Gulf nations also had a huge impact. Therefore, from the broader economy point of view, this would lead to one reduction in the overall expectation that one would have had on various economy, whether it is from US, whether it is rest of Asia, as well as India, and energy being one of the largest component of fuel, is the largest component of every country in terms of import. So it leads to one, import cost going up. Second is it leads to increase in the inflation potentially. And third, of course, as the price levels go up, the economic activities comes down. Therefore, the GDP number gets shaved off by about, say, 20-30 basis points. So this is a larger impact because of which we have seen recent volatility in the equity market, largely to represent these uncertainties which suddenly has come. Now, having seen this uncertainty, I'm sure in the history, if you look at it, while this is a new normal that we can say, about the knee-jerk immediate reaction that comes in, which in my own belief is would have got already factored in. And as things settle down, as I speak, there are certain progress being made in terms of ending the war. We still do not know whether it's going to be ending very soon, or even if it continues, how long it can continue. But one realization has come among most of the global economy: if it continues for too long, and then oil prices stays very high for too long, as a result of that, if there is a shortage of oil for most of the countries and the gas, this could potentially impact the economic, most of the economy, global economy big time. Therefore, it can lead to some bit of recession kind of period. So that fear now is set in. Even the public noises that's coming in US and other market leaders now suddenly start realizing the importance of bringing this current uncertainty to an end very soon. Therefore, we will be in that process. But having created damage, we must make an assumption that this will have some impact at least for 1 or 2 quarters in terms of overall economic growth as well as on the company's earnings. In particular to India, we must realize the last, say, 10 years, making it more India self-sufficient in the energy sectors by way of promoting renewable energy is one of the alternate, and India has progressed quite a lot in making India the largest producer of renewable energy in the world. And second is consumption of the focus on building an infrastructure, focus on building India as a manufacturing hub, and focusing on the rural development and also the agriculture sectors. India has been relatively doing better than the most of the economy. But we must also accept the fact that India is still the largest importer of oil. Therefore, to the extent it can have an impact both in the fuel prices remaining high, though the government is not going to pass on immediately the high crude oil prices to the consumers. But however, the industry, they're largely linked to the oil price movement, so they'll get impacted. And second is interest rates, which has been coming down for the last 1 year. There is a high probability that now we'll come to the neutral stance rather than having a lower bias kind of thing. Therefore, this will also keep the interest rate somewhat at where they are currently, or maybe it can even marginally inch up if this cost impact remains high. So while 90% I would say India will remain somewhat insulated from the global crisis, but over 10 to 15% of impact will come. So which something which I think India can manage it, given the fact that we are now becoming a better economy in every aspect because of inclusive growth that we are looking at it. Various sectors, of course, variety of sectors were predominantly the usage of oil, chemicals, fertilizers, and OMCs, and the oil producing companies. Of course, will be the oil producing companies will be the beneficiary, whereas OMCs, oil marketing companies, could lose some money because import of oil price is high, but they are not passing on the increase in oil prices to the consumers by of increase in petrol and diesel prices. And these are some of the sectors could get impacted because of availability of gas not being there. Some of these fertilizer chemical industries largely uses the fuel of gas could potentially have an impact. I would only assume that that current uncertainty, if it doesn't last for too long, I think we should be able to get back to normalcy, given the fact that our international relationship is actually one of the best in the world, and we have our friendly nature with most of the nations is also quite high. Therefore, our ability to manage these current situations could potentially be far better than most other countries. So the investor's point of view, the question always remains that this kind of uncertainty, what do I do? Historically, any such uncertainty that has come, it lead to a fluctuation in the market. It's not a one-way traffic where this keeps going up, and making money is not permanent. I always believe that market will remain volatile. I think what is most important during this period from investors' point of view, stay invested, stay calm, and continue to keep a focus on long term rather than getting worried about the short term. I must also mention that those who have come in the last, say, 2 years in the Indian mutual industry, including ABSLAMC mutual fund, and they have not have got much return, given the market volatility has been there for the last 1.5 years. From India point of view, those investors should see this as an accumulation phase. For everything, there's an accumulation phase. That's the period you keep accumulating it, and then when the market goes to the bull market, you make money. When the bear market, of course, lose some of your profit. It's not about you are losing your capital, lose some of your profit. But they always come only if you accumulate your profit, accumulate your money, get your profit, then it comes in the loss in profit. That's why it happens. So from investors' point of view, stay focused on investing in diversified equity funds such as a flexi-cap fund or multi-cap fund. Also, the conservative investors can consider balanced advantage fund where the money manager takes a call in terms of increasing exposure to equity, depending upon what is the view on valuations, view on market outlook, and so on and so forth. Various parameters they use for increasing or decreasing equity exposure and dynamically manage the portfolio. So from investors' point of view, they should stay invested on board, or the investment, lump sum investment can come through the balanced advantage fund, and then move into the flexi-cap fund where the money manager uses the discretion to move between large cap, mid cap, small cap. Often this question keeps coming in. Therefore, multi-cap and flexi-cap could be the which choice they can take. See, from the interest rate point of view, the current uncertainty is actually negative in the sense that the Reserve Bank of India has been cutting interest rates in India, as is known, since January 24. They cut the interest rate by 125 basis points. As against that, yields have gone up. Yields have gone up for a variety of reasons. One, of course, government borrowing program continues to remain very, very extensive and coming from state government borrowing in the long run to the bond market curve. Second is inflation has been quite under control. We can still say, even if the inflation as a result of the current uncertainty goes to say 4%, we must accept the fact that it's going from 1 to 4% is still remaining within the tolerance number. I think the tolerance number for India for inflation is about 4% plus or minus 2%. That means it can go up to 6, then come down about 2. Given the fact that we are already in the low interest rate regime, even if it goes up by say 2 or 3%, I don't think one should get too much worried about it. And because of high oil prices, import has goes up, and because the FIs and FDI are selling, FI is selling especially, your balance of payment also comes to some kind of brink. It comes to some kind of weak position. To the extent the room that the monetary policy authorities will have for cutting rates is almost ruled out. Whether they can hike at this point of time, doesn't look like. They can actually continue to keep the monetary policy more or less is flat and neutral for at least the whole of year 25, 26, 27 I would say. So from interest rate point of view, we would probably see more of stable kind of interest rate scenario. From investors point of view, definitely the carry goes up. Whenever the interest rate goes up, if the 10-year bond is close to about 7%, it essentially means that I'm going to get 10%, 7% as a coupon, which will accrue in my portfolio. Some mark-to-market loss will come, no doubt. But 7%, the interest rate goes up from investors' point of view, it gives me accrual benefit. And therefore, those who are fixed income investors, conservative investors, they should stay invested in the low duration fund or the corporate bond fund or money market fund, in which they can of course park themselves and enjoy the benefit of higher accrual that could come in next year with interest rates marginally which has gone up in the recent past, not through the policy action, through the market action. And that's something can be kept in mind. But having said that, all the fixed income investors can also participate through the equity savings fund, which invest in a large component of the money in fixed income schemes, and 20% is in equity, and still gives me equity taxation. The equity savings fund could be one of the options can be considered. And the last but not the least is the arbitrage fund. It gives a tax adjusted return by way of equity kind of status. Even if it gives about say 5.5% return, it's actually better than any investment that you may have within the bank asset classes, because the tax return of 5.5% can also come in the arbitrage fund. Therefore, from conservative, ultra conservative investors who predominantly invest in fixed income, also there's an opportunity I would say at this point of time with the interest rates marginally staying higher level. So one good thing that has happened for the Indian mutual fund industry, where large pool of public savings have been coming through the SIP, systematic investment plan, through which coming every month. The Indian mutual fund industry gets close to about 39 crores. Aditya Birla Sun Life Mutual Fund gets close to about 1150 to 1200 crores kind of flows that we get. And this is again coming from large pool of investors with a small ticket size about say 3000 rupees or 4000 rupees, as low as about 500 rupees. All such investors would have realized that while they have been saving continuously, they would have seen big money being made on the investment. At the same time, they would also seen no money being made, and they would have seen in the last 1 year negative return also. But the fact of the matter is that you would have realized over a period of time, those who have been investing, we have realized at the same time, we all as a mutual fund continue to harp on as the best way to save in Indian capital market and create a wealth for yourself is through the SIP. That's something important plan, what we call it. And SIP for life, what we call it. Again, SIP for life means that invest for your entire lifetime, is up to the age of 60. Then after that you have a withdrawal plan. That's something we can always promote it. The reason why we are saying 60, the longer the period for which you are able to do SIP, the better the discipline that you will have by way of accumulating money and your savings. And therefore the market, when they go up and down, you get to participate in the upside as well as the downside, and eventually actually make money. That has now become the new norm, I would say, which is the bigger change that has come for the Indian capital market and the mutual fund industry. Even for investors' benefit also, this will work out pretty well. Therefore, SIP is something I always say that you should not look at your value of your portfolio. You should not look at market fluctuation basis which you should withdraw. Continue to make the investment. If you don't have, start it. If you have it, continue. If you have more money, add more to the SIP.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.